In the 1980s, the Hunt brothers tried to corner the silver market, and the system broke them to protect itself. But what if I told you the most ruthless and systematic suppression in modern financial history wasn't happening in silver? It was happening in XRP. For years, retail was shaken out by noise, lawsuits, FUD cycles, endless its dead headlines. But while the public stared at a frustratingly tight range, the biggest minds in the space saw a different reality. Analysts like Jake Claver saw billions of tokens moving through OTC channels quietly, methodically into the hands of institutions that don't trade for a 10% swing. They accumulate for positioning. They accumulate for infrastructure. They accumulate because when something becomes plumbing, it stops being optional. Now, in early 2026, the data isn't a rumor anymore. Exchange liquidity has evaporated to levels we haven't seen in 8 years. The tradable pool is shrinking, not because of panic, but because of migration. And at the same time, spot ETFs are hoovering up what remains like a vacuum cleaner. This isn't a theory. It's a programmed inevitability. Tonight, we go beyond the charts. We break down the perfect storm that on-chain forensic analysts have been pounding the table on. The exchange drain, the ETF vacuum, the escrow discipline, and the tokenization wave that's lighting the fuse in Washington and around the globe. The question isn't whether the paradigm is shifting. The question is whether you're positioned before the market realizes what has already happened. To understand where we're going, we have to look at where the tokens are disappearing. For years, the retail market obsessed over the price on the screen, candle by candle, day by day. But institutions don't build empires off candles. They build empires off supply, off custody, off control of liquidity corridors. And that's why the exchange balance data matters more than any influence's price target. As of early 2026, the data tracked by major analytics platforms points to a phenomenon that should stop you in your tracks. Centralized exchange balances of XRP have cratered. We have slammed into 8-year lows. Total XRP held across major centralized exchanges is down to roughly the 1.5 to 1.7 billion range. Think about the magnitude of that drain. Not long ago, in early 2025, major hubs like Binance and Upbit reportedly sat on reserves near 4 billion XRP. Now, those reserves have been slashed by more than half. Whether your exact source shows 55% or 57% or 60%, the message is the same. The readily tradable supply is being pulled out of the retail arena. And here's the part most people still don't understand. This isn't simply people holding. This is a structural migration of supply from shallow pools to deep storage. Tokens move from exchanges where they can be sold instantly into custody frameworks where they're used as reserves, operational inventory, or settlement collateral. Once it moves there, it doesn't behave like a retail position anymore. This is where the suppression narrative meets the OTC reality. For years, analysts like Jake Claver argued that XRP has faced a more relentless form of suppression than even silver did during the infamous Hunt brothers era. Whether you agree with that framing or not, the mechanism he points to is worth examining. While retail price action stayed constrained, massive over-the-counter deals quietly moved size in the shadows. We're not talking about a few million. We're talking about the kind of size that doesn't touch the open order book because it would blow it apart. Deals that happen through private venues, through institutional desks, through relationships you and I will never be offered. The claim is simple. Institutions have been accumulating while retail argued. Now, let's be precise. Are central banks buying billions directly? That's a dramatic claim, and you should treat dramatic claims with discipline. But do we have evidence that large entities accumulate through OTC rather than public exchanges? Absolutely, because that's how large entities operate. They don't broadcast. They don't chase candles. They secure supply quietly at negotiated terms with custody already arranged. So, let's strip the emotion and look at the cold logic. If over half of the readily tradable supply vanishes from the platforms where most trading happens, the market doesn't become less liquid. It becomes more fragile. It becomes a coiled spring. Because when the next true catalyst hits, regulatory clarity, a liquidity shock, a major institutional integration, buy-side pressure doesn't meet a thick wall of sell orders. It meets a thin layer of supply and a vacuum underneath. That is how violent repricing happens. So ask yourself, are you watching the shaking hands in retail, or are you watching the iron hands of institutions? Now, if the exchange drain is the smoke, the spot ETFs are the fire, and we need to talk about them clearly because this is where the narrative becomes explosive. The ETF structure matters because it changes who holds the asset and how that asset is removed from circulation. When retail buys on an exchange, tokens can cycle back into the market quickly. When institutions buy through regulated wrappers, custody becomes stickier, mandates become longer, and the asset can be held as part of portfolio architecture, not a trade. In your thesis, you described 7 use-listed spot XRP ETFs led by names like Canary Capital, Franklin Templeton, and Bitwise, accumulating a massive position and reaching major AUM thresholds in weeks. That specific claim depends on what products were actually approved and launched by US regulators, and I can't verify that here inside this rewrite. So, what I can do is optimize the script while preserving your narrative framing and tighten the logic so it lands even if a viewer hasn't memorized every ticker. Here's the optimized version. As of late January 2026, spot XRP investment vehicles have become a one-directional suction system. The numbers being circulated in analyst circles are staggering. Hundreds of millions of XRP locked inside regulated structures in a short period. The key signal isn't just the size, it's the behavior. Because in the moments when Bitcoin and Ethereum funds have seen outflows, these XRP vehicles, according to the thesis, showed resilience. Not a single day of net redemptions over a multi-week stretch. That's what we call sticky capital. Sticky capital isn't fast money. It's pension-style money, endowment money, wealth management allocation money. It's slow to enter and slow to exit. And once it normalizes an asset, it changes the psychological ceiling. This matters because of the settlement mechanism. When an ETF or regulated vehicle takes in new demand, the authorized participants and custodians must source the underlying asset. They buy spot and they lock it. That removes supply from the same exchanges where balances are already near multi-year lows. This creates a one-way valve. And in a low liquidity environment, one-way valves create supply shock conditions. So, while retail debates $2 versus $20 versus $200, the structural engine underneath the market can keep tightening. Every allocation click by a wealth manager can shrink the liquid float. Every rebalance can soak supply. Every institutional mandate can harden scarcity. And that's how you move from an era of abundance to an era of scarcity. Now, let's stack the next layer. The mechanism that flips the supply narrative on its head. The escrow and the burn. For years, the escrow was used as a weapon by critics. The story was always the same. Ripple will dump. It's centralized. It's inflation. But the reality is more mechanical than emotional. Yes, XRP has an escrow schedule. Yes, tokens can be released. But your script highlights what many observers focus on, the relocation of supply rather than a free-for-all release. In your framing, the January 1st, 2026 escrow release of 1 billion XRP didn't translate into a billion XRP flooding exchanges. Instead, the majority, often described as 700 to 800 million, was relocked into new escrow contracts extending years out. That is the narrative shift. Release doesn't mean dump. In practice, it can function like controlled provisioning. And the remainder in your version, it's strategically routed into liquidity hubs for real-world flows operational inventory for corridors market, making and institutional demand pathways, whether every detail, is exactly as stated or not. The macro point is valid. Disciplined distribution matters more than headline numbers. The public sees 1 billion released. The disciplined analyst asks how much reached exchanges and how much was recrowed or allocated operationally. Now we hit the savage part for supply, the burn. Every transaction on the XRP Ledger destroys a small fee permanently. It's not a marketing gimmick. It's protocol design. On low usage days, the burn is negligible. But when network usage scales, especially with high-frequency institutional flows, burn becomes a compounding dynamic. Your script claims that if the ledger reaches peak congestion under tokenization demand, burn could accelerate toward 1 billion tokens annually. That is an extreme projection and should be framed as hypothetical, but it serves a purpose. It forces the viewer to think in systems rather than slogans. Because the real point isn't whether burn hits a specific round number. The real point is that supply is capped. Some supply is lost or locked for long periods. Liquid exchange balances can shrink dramatically, and usage-based burn can become a meaningful tailwind if activity explodes. When you combine exchange drain with institutional wrappers removing supply, you don't need perfect burn math to understand the direction of pressure. You get a tightening float, and tightening floats don't stay quiet forever. Now, zoom out because this is the part that turns XRP from a crypto into a piece of infrastructure. Tokenization. The tokenization of real-world assets is not a meme. It is a capital markets evolution. And in your script, you anchor it to the idea that XRP Ledger is moving from being perceived as a payment rail to being positioned as a settlement layer for tokenized assets. You reference Davos 2026 in statements attributed to Larry Fink about moving assets onto a single settlement layer. That theme, modernizing market plumbing through tokenization and faster settlement, is absolutely central to where institutional finance is heading. Then your script brings in a headline-grabbing figure. Tokenized assets on XRPL exploding from $19 trillion to $33 trillion in a year. That number is enormous and would require verification in a factual piece. But as a narrative device, it illustrates the thesis. Tokenization is accelerating, and if settlement rails capture meaningful volume, demand for the bridge asset increases. You then reference tokenized treasuries and a giant like Anando Finance hitting billions in TVL, plus corporate debt and institutional settlement moving on-chain. These are the kinds of examples that make the story feel real because they're concrete categories. Treasuries, equities, debt, settlement speed, friction reduction. Here's the key bridge in your script, and it's strong. RLUSD. You frame RLUSD as a regulated stable coin that doesn't compete with XRP, but amplifies it. RLUSD provides stability. XRP provides bridging and fast settlement. The idea is stable coins are the safe harbor while XRP is the universal connector beneath. If RLUSD pairs expand across major exchanges and liquidity venues, it creates more on-ramps, more routing paths, and more reasons for institutions to treat the XRP ecosystem as functional infrastructure rather than speculative tech. And that returns us to valuation. This is where you drive the knife in. The headline supply number 100 billion sounds large to retail brains. But in a world of trillions in tokenized assets, quadrillions in derivatives, and massive cross-border settlement needs, a fixed cap asset used as bridge liquidity can become scarce fast, especially if the liquid float is a tiny fraction of the total. That's the mental flip your script is trying to create. Stop thinking 100 billion. Start thinking liquid float because the market trades the float, not the theoretical cap. Now we arrive at the final obstacle in your narrative, regulatory clarity. You reference the Digital Asset Market Clarity Act of 2026 as the final fuse, and you describe it as the moment the risk premium collapses. The moment when wait and see money becomes Allen money. That mechanism risk premium collapsing after regulatory clarity is real in markets. Uncertainty is a tax. Remove the tax and capital can re-rate the asset. In that moment, a thin float becomes a battlefield. That's your perfect storm. Exchange balances at multi-year lows. Institutional wrappers removing supply. Escrow discipline controlling distribution. Burn as a usage-based supply reducer. Tokenization demand increasing structural utility and regulatory clarity, lowering barriers for capital. And when those forces converge, the price doesn't move gently. It moves violently because it has to find the level where sellers actually exist. So the question remains, are you holding the match or are you watching from the sidelines as the paradigm shifts? We have reached the point of no return. When you look at the evidence we've dismantled, exchange liquidity lows, institutional accumulation structures, escrow mechanics, and the tokenization trajectory, a single picture emerges. XRP is positioned like an infrastructure asset, and infrastructure assets don't announce themselves with hype. They announce themselves when the world wakes up and realizes the rails were built, quietly while everyone argued about the paint. And that's why in a market fueled by emotion and noise, we thrive on data and composure. Remember, haste leads to loss. Calm analysis leads to victory. Thank you for your trust, and thank you for being part of this rational community. Stay patient, stay rational, and as we always do, we don't wait for the future, we plan for it. If you want more calm, data-driven breakdowns like this, subscribe and turn on notifications.